In this demonstration, I will show you how to perform an integrated financial planning allowing to capture income statement, balance sheet, and cash flow impact of decisions. I will highlight how what-if analysis can be used for evaluating different possible scenarios. We'll start off by reviewing the latest available forecast, comparing the annual business plan and review how the different business units are performing. But before doing that, note that the workbook we are looking at contains a couple of different tabs to support you in the integrated financial planning process and ad hoc analysis. The starting page is a CFO dashboard which presents an overview of current forecast and reference data to the budget, but also to actuals. Following, we have the income statement and the trial balance sheet, and cash flows, both according to direct method and indirect method. In addition, we present the important KPIs, but also a what-if analysis tab that we will use later on. But let's start off in the CFO dashboard. And as you see, we have a highlight on important dynamic KPIs. And when I say dynamic, it means that once I start exploring the performance of my organization, they will display KPI for the subset that I'm reviewing. For example, business unit, regions, month, year, product, etc. Note that Planning Analytics that we are utilizing has many of the rich capabilities you would expect from a modern business intelligence tool, but with a single huge advantage. Planning Analytics allows you to make the data entry, which differs from Tableau, Qlik, Power BI, and Cognos Analytics, for example. Data entry will allow you to perform what-if analysis or planning of different sorts. To the left, you can find the defined filters to perform analysis, planning, and what-if. So let's explore them in more detail. First of all, let's review the organizational structure. And in my example, I have the entire group companies divided into different regions and different legal entities. And this is a long list, and it can of course be adopted to your organizational structure. Further, if you want to go in and customize the subset that you are filtering from, you can choose the Edit Subset Editor. And here you will be able to do even more granular selections or saved as your favorites. Let's try them out. So we'll first filter on the Eastern region, and we can see that the KPIs with the sales forecast, comparing the current one against budget, but also the gross margin net income is reflected here. Also the more detailed table of the income statement comparing the different versions against each other. This can be filtered even further down on the legal entities, and the data will be instantly updated. If we move further along to the income statement, the same applies here. We can filter on years, months, current forecast, etc. And the dimension filters are common throughout the model and can also be leveraged here, of course. When filtering Massachusetts, we can see the monthly sales, the current forecast, but also against the budget that we outlined earlier. If we move into the KPI tab, here we have the important KPIs, both from an income statement, balance sheet, and cash flow, calculating return on assets, return on equity, asset turnover, etc. These are KPIs that you define as part of your financial targets. Note that the versioning allows you to view both the current forecast but also the actual budget and previous versions. Let's move on to the trial balance. Note that Planning Analytics allow you to follow up and plan financial information stored on accounts, but equally important is to be able to use driver-based planning with volumes, hours, quantities, or ratios. And in this example, we see driver-based planning, which enable us to utilize days of sales outstanding, for example, or days of raw material outstanding, or days of purchases outstanding. All of those are important KPIs when predicting the balance sheet and cash flow impacts, which we'll later on discover. Let's move on to the balance sheet. And note that in the balance sheet, we can see the net working capital displayed at the top here, and we can see the current forecast of working capital comparing against the budget. Further down, we have the entire balance sheet with accounts, with current assets, long-term assets, liabilities, and equity. And towards the bottom, we calculate the net working capital. And of course, there are naturally a lot of calculations going on to support an integrated financial model, but important to note that Planning Analytics has a smart way of performing these calculations. Compared to Excel, you author them once and not in each combination and cell. You can easily right-click any calculated cell to review how it's being handled. This gives you an audit trace with a clear track record. Let's see how it works. So let's, for example, see how net working capital is being calculated. We right-click and trace the cell. And we can easily see here that the underlying amount, the value here, is calculated through the quick assets, which is cash and cash equivalents, accounts receivable, adding up to 8.7 million, deducting the current liabilities, which makes up a number of accounts payable, accrued expenses, interest payable, etc. We can dig even further down to the calculations if we want to review them. Let's move on to the cash flow. Note how income statement, trial balance, and balance sheet allow us to calculate cash flow. We can visualize this in, for example, a waterfall chart like we have here, or in a table as we see below. Before moving on, I'd like to perform an overall summary of what we've seen so far. With the integrated financial accelerator for planning analytics, we can create an integrated planning, reporting, and simulation model for your entire enterprise. We can capture both account-based financial information, but also drivers, for example, days of sales outstanding, raw materials, and purchases outstanding. Information can be analyzed in various ways and consumed by the end user. So now let's start with planning and what-if analysis. We will start off by performing the planning and what-if analysis in the what-if analysis tab. So in this part of the demo, I will show you how you can make an update to the plan, a forecast or a budget, for example, but also how you can leverage simulation through what-if with sandboxes. We will start this simulation by narrowing down on one of our legal entities, which are Maryland. Let's start by reviewing what we see here. So we have the current forecast for this legal entity, and let's assume that we want to simulate a 20% drop in sales revenue and also raw materials starting from March. But we will also offset this sales drop with a 10% reduction on labor cost. In order to do that, I can simply make an update to the current forecast, but it might be that I want to review the possible effect before committing this to the plan. So for that purpose, I will create a sandbox called worst case. And as we can see here, we have the scenario right now for the sandbox, which is base. So I'll create a new sandbox. Called worst case. And as you can see, once I created the sandbox worst case, it copies my base data into a separate version. This will allow me now to make changes to the worst case scenario and compare it against my initial scenario, my base. We'll make sure to filter the worst case. And then start applying my updates. From March until December, if you recall, we want to simulate the impact of a decrease in sales with 20%. In order to make this input, I can make an entry cell by cell, calculating it manually. This will be time consuming, so I prefer to use either the spreading function or the short commands. I will show you the spreading function, how they work first. I right click, choose spread data. From here, I can choose a number of different spreading options. In this case, I will use percentage change and type in 20%. I want to subtract 20% from my current values, and I want to copy it to the right. Note how the figures are turning blue, and we can also see the overall sales is now declining compared to the base case. In the raw material example, we will decrease the consumption of raw materials with 20% as well. But in this case, I will not use the spreading function. Instead, I will use the short command. We type in decrease. We'll type in decrease with 20 and then an arrow to the right. So this means I will copy decrease 20% to the right. And as you see from the blue figures, they are now kicking in with the change of entry. For the labor cost, we foresee that we will be able to make a reduction of 10% in a similar way from March until December. So let's assume I want to compare the worst case now with the base that I initially had. I can easily do that by highlighting the two scenarios, right-click, and create calculation. I will call this worst case versus base. I will pick the calculation, and it will allow me to input the various calculations for me. In this case, we can easily see that the sales number are now decreasing, offsetting raw materials and labor costs, but still having an impact on net income. All of these calculations are performed in real time, and this is what real-time planning is all about. Having business rules executing in real time allow you to see the impact instantly when you make the plan. So we can clearly see the negative impact on the income statement on revenue and gross margin, but let's assume that this simulation doesn't stop here. Let's say that we will aim for prolonging the payment times for purchases based on this downturn. And how can we do that? Let's move into the trial balance. We have the different KPIs here with days of sales outstanding, raw materials, purchases, etc. And in this simulation, we want to aim for an increase of days of purchases outstanding. So instead of 33 days on average, we want to increase this to 40 days. And as we can see here, we can see the figures are turning blue, of course due to the changes that we have done in sales figures, but also on the raw materials. So now let's assume we will aim for increasing the days of purchases outstanding from 33 to 40 days from March. We can enter, for example, 40 days here in March, and we can instantly see that the accounts payable end period is changing once we do perform these updates, increasing that one and the payment times. But of course, instead of doing this one by one, we can also, similar as we did before, copy the 40 days to the right. So we have now made both the changes to the income statement, to the trial balance, and now let's continue reviewing the balance sheet. And we can already here see that the net working capital is changing. And if we want to see the effect, we can look in the graph at the top or the table below where we have the calculation for net working capital. If we simply switch between the two, we can see the changes in real time. So the working capital for the month going ahead here is declining with about 10%. So let's now see how it impacts the cash flow. We can easily see that the cash flow equivalence at period end is 10.4 million in the worst case scenario. In the base, it was 11 million. So the cash flow is degenerating due to this downturn that we foresee. This can also be highlighted in a waterfall chart, which gives you visibility into the cash flow changes by month, and we can see that overall we have a positive cash flow except for April. We can easily go into the table and review what kind of impact. We can see that income taxes paid is 1.1 million for Maryland specifically in April, causing the downturn in the cash flow. So finally, let's review the important KPIs that we have in the KPI tab. And let's make sure that we have the worst case scenario here. And maybe we want to compare it side by side. You can easily do that. By adding the worst case scenario side by side. And we see in the original scenario, we had a net income growth of 6.25%, return on assets 12.6, return on equity 25%, asset turnover ratio is 0.41. If we compare to the worst case, if we compare against the worst case, we can easily see that the net income growth is declining, return on asset and return on equity is declining, as well as the asset turnover ratio. So this gives us the worst case scenario comparing to our base scenario. So as a final comment to this simulation, you can create multiple changes to any scenario, as you saw here, declining sales figure, combining with KPIs from the balance sheet and trial balance, etc. Depending on what kind of information you have in your information model, it will actually allow you to make these multiple changes and see the impact on the overall financial performance. You're also able to not complete only one scenario, like the worst case here. You can have a best case or another likely case or whatever, and have those multiple scenarios outlined side by side or doing it one at a time. So very powerful. But it doesn't stop there. So once you've done a scenario, you can decide whether to commit that worst case scenario to the overall base plan. So this means that the worst case here would actually copy the data over to the base plan by choosing commit data. It will double verify with you that you would like to perform this change. And once you perform it, the base is now changing and the worst case is now the same as the base. You can delete the sandbox once you're ready to clean it up, and it will disappear from your views. So to summarize, in this second part of the demo, I showed you how to create a what-if simulation using built-in sandbox functionality. It's a powerful capability that allows you to model and simulate possible outcomes based on your data and business logic. Calculations are performed in real time, which will give you a rapid response to simulations that you like to perform. So with that, I want to conclude this demonstration.